Welcome back to Today Assets Report, the channel where we don't just chase numbers, we chase the truth behind them. I'm glad you're here today because what we're about to break down is one of the most talked about comparisons in the crypto space right now. Three of the most powerful AI models on the planet, ChatGPT, Grok, and Gemini, were all asked the exact same question. Under the most bullish conditions possible, where does XRP end up by the end of 2026? And the answers they gave back were so wildly different from each other that people across the internet lost their minds. ChatGPT came in at $20. Grok fired back with $250. And then Gemini walked into the room and said $1,000. Three AI models, three completely different answers, and three completely different ways of thinking about the problem. Now, most people saw those numbers and immediately started arguing about which AI was right. But here at Today Assets Report, we're not interested in that debate. We're interested in something far more important, which AI was even asking the right question in the first place. And when you look closely, the answer to that is genuinely shocking. Voice. The wrong question. Everyone is asking. Here's something that almost nobody in the XRP community is talking about, and it's the most important analytical point you'll hear all week. Every single price prediction you've ever seen for XRP, whether it came from an influencer, a trader, a hedge fund analyst, or an AI model, almost always starts from the same place. It starts by asking, how high can XRP go? How much retail money might flow in? What does the chart look like? What did it do in the last bull cycle? And those are perfectly reasonable questions if you're analyzing a speculative asset like most cryptocurrencies. But XRP is not most cryptocurrencies. XRP has a specific architectural function that is fundamentally different from Bitcoin or Ethereum or anything else in the space. It was designed from the ground up to act as a bridge asset, a financial instrument that sits in the middle of international settlement transactions and allows value to move across borders in seconds without the need for pre-funded accounts sitting in banks around the world. When you understand that, you realize that the right question isn't how high can XRP go. The right question is, how high does XRP have to go for the system it was built to power to actually work at the scale it was designed for? And that question, that specific, precise, engineering-based question, has a mathematical answer. And that answer changes everything. Voice, two types of analysis, and why the difference is everything. Let's slow down for a second and really lay this out clearly, because this distinction is the foundation of everything we're going to talk about today. There are two fundamentally different types of price analysis, and almost every conversation about XRP mixes them up in a way that produces completely useless conclusions. The first type is what we'll call sentiment-based projection. This is the framework where you look at how much money might flow into XRP, how bullish the market cycle is, what the ETF inflows look like, and how excited retail investors are getting. You take all of that emotional and capital flow data, you run it through historical cycle comparisons, and you spit out a number that reflects what the price might reach if sentiment is strong enough. This is the framework that ChatGPT used. It's also the framework that Grok used, at least partially. It produces numbers that sound reasonable, but they have no relationship to XRP's specific utility function as a bridge asset. The second type is engineering-based constraint analysis. This is the framework where you ask a completely different question. You ask, given the transaction volumes that XRP is designed to handle, and given the available liquid supply of XRP in the market at any given time, what does the price have to be so that routing a large institutional transaction through XRP doesn't cause so much market disruption, so much slippage, that using XRP becomes more expensive than just using the old banking system? That's a precision engineering question, and it produces a precision engineering answer. Voice breaking down ChatGPT's $20, why it's solving the wrong problem. So let's start with ChatGPT's $20 prediction, because understanding exactly why it's wrong is the most useful analytical exercise we can do here. ChatGPT built its $20 target using a combination of historical bull cycle patterns, ETF inflow modeling, retail momentum projections, and supply shock dynamics. It looked at things like institutional inflows of $4 to $8 billion, payment adoption growth curves, and retail mania comparable to what we saw in 2017. And based on all of that, it landed on $20 as the extreme blow-off top under the most bullish possible conditions. Now here's the thing. None of those inputs are wrong. ETF inflows are real. Supply dynamics matter. Retail momentum is a genuine market force. The problem isn't the inputs. The problem is the analytical framework that ChatGPT used to process those inputs. ChatGPT treated XRP as a speculative retail asset whose price is set by the intersection of supply and demand in the open spot market. That's the exact same framework you'd use to analyze Bitcoin or Dogecoin or any meme coin. But XRP doesn't operate primarily in that framework. Its price has a second, far more powerful constraint: the volume of value it must bridge in institutional settlement. Think about what $20 actually means in practice for a real institutional transaction. If a major financial institution is trying to route a $1 billion cross-border payment through XRP's on-demand liquidity system, and XRP is sitting at $20, that transaction requires 50 million XRP tokens just to complete. 50 million tokens. With most of the circulating supply locked in cold storage, ETF custody, and XRPL reserves, the available liquid supply is a fraction of the total. Trying to route 50 million tokens through a limited liquid market creates massive price slippage. It moves the market against you so hard that the economics of using XRP become worse than just wiring the money through the old correspondent banking system. ChatGPT did not model that constraint, not because it's a bad AI, but because it was answering the wrong question. Voice. Grok's $250. Right framework, wrong demand driver. Now let's move to Grok's $250 prediction, because this one is genuinely more sophisticated, and understanding where it falls short is actually the most instructive part of this entire comparison. Grok's framework was meaningfully more advanced than ChatGPT's. It started by doing something important. It didn't just take the full circulating supply of XRP and multiply it by a price. It actually accounted for effective circulating supply by excluding tokens locked in reserves, ETF custody arrangements, and cold storage. Grok estimated that effective liquid supply at around 35 billion tokens. Multiply that by $250 and you get a market cap of roughly $875 trillion. Grok then identified three catalysts that would need to fire simultaneously to reach that number: supply shock dynamics, contracting the liquid supply even further; massive retail adoption, adding demand pressure from the consumer side; and institutional deployment, creating sustained floor demand. And critically, that answer is internally consistent. Grok actually did the supply dynamics math correctly. It understood that the effective liquid supply is far smaller than the headline circulating supply, and that matters enormously for price dynamics. So why is $250 potentially conservative rather than aggressive? Because Grok, despite its better supply modeling, still made the same fundamental demand-side error that ChatGPT made. It modeled retail adoption and ETF inflows as the primary demand drivers. It was still, at its core, asking a sentiment-based question about how many investors want to own XRP. What Grok did not model, what it completely left out of the equation, is the demand that comes from institutions that are not buying XRP as an investment. They're buying XRP because they have to. They need it to settle transactions. That demand is not discretionary. It doesn't reverse when sentiment turns negative. It doesn't slow down when retail investors get scared. It scales directly with transaction volume, and transaction volume scales with institutional adoption. That's a fundamentally different demand driver, and it's the one that Grok's $250 model didn't capture. Voice. Gemini's $1,000, the only model that asked the right question. And now we get to Gemini's $1,000 scenario. And I want to be really precise here about what makes this analysis different, because Gemini itself framed this as a speculative outlier. But when you look at the actual reasoning behind it, it's not speculative at all. It's engineering. Gemini's $1,000 argument is built entirely on liquidity mechanics, and the logic is clean and simple once you see it. If XRP is trading at $1,000 per token, and an institution needs to route a $1 billion payment through the system, that transaction only requires 1 million XRP tokens. 1 million tokens out of a circulating supply in the tens of billions. That's a fraction so small that it barely moves the market. The transaction executes with minimal slippage, the economics work better than correspondent banking, and the institution has every incentive to use the system again. Now flip that scenario. If XRP is at $20, the same $1 billion transaction requires 50 million tokens. That's a market-moving order that creates slippage so severe it potentially destroys the economic case for using the system at all. Gemini identified $1,000 not as a speculative price ceiling driven by hype and momentum. It identified $1,000 as the minimum price threshold at which billion-dollar institutional settlement transactions become economically viable through XRP's infrastructure. That is a completely different kind of number. It's not a prediction of where sentiment might push the price. It's a constraint, a floor below which the system cannot perform its designed function at the scale it was built for. And when you understand that distinction, everything about the XRP price narrative changes. Voice, the $60 trillion market cap. Question. Now at this point, some of you are probably thinking, wait, $1,000 per XRP would mean a market cap of $60 trillion. That sounds absolutely insane. That's bigger than the entire US economy. How could that possibly be a legitimate number? And it's a completely fair reaction. On the surface, $60 trillion sounds like pure fantasy, but here's the framework that makes it make sense. XRP is not a company. It's not a startup raising capital. It's not even really an investment in the traditional sense. It's a settlement asset, a financial instrument designed to sit at the center of global value transfer, the same way that currency sits at the center of economic exchange. And when you think about it through that lens, the comparison to corporate market caps or even cryptocurrency market caps becomes less relevant. What becomes relevant is the scale of the financial infrastructure that XRP is designed to service. Consider this: SWIFT, the messaging system that coordinates international bank transfers, processes approximately $29 trillion in daily transaction volume. Not annually, daily. The M2 money supply of the United States alone exceeds $21 trillion. Global foreign exchange markets turn over more than $7 trillion every single day. These are the systems and the volumes that XRP's architecture is designed to interface with. A $60 trillion market cap for the settlement asset at the center of global financial infrastructure is not inherently absurd. It's the mathematical consequence of the system functioning at the scale it was designed for. Gemini understood this, and framing that understanding as a speculative outlier rather than a structural constraint was, in my view, the only real mistake in Gemini's analysis. Voice. Where we are right now. The $20 world is already behind us. Let's connect all of this theoretical analysis to the documented, on-the-ground evidence of where XRP actually stands today, because this isn't just about projections and models anymore. There are real institutional moves happening right now that tell you exactly which world we're building toward. The $20 world, the world where XRP is primarily a retail speculation asset with some payments utility on the side, that world already has an expiration date on it. The evidence that we have left that world is stacking up fast. Goldman Sachs holds a documented XRP ETF position. That's not a rumor. That's a regulated financial disclosure. The DTCC, the Depository Trust and Clearing Corporation, which is the backbone of American securities settlement, named the XRP ledger specifically in a settlement patent filing. Brazil's treasury bonds, representing $1.5 trillion in sovereign debt, are in the process of deploying on the XRP ledger. The SEC and the CFTC have jointly classified XRP as a digital commodity, which is the regulatory clarity the institutional world has been waiting years for. And MasterCard, one of the largest payment networks on Earth, paid $1.8 billion for infrastructure whose settlement layer runs on RLUSD on the XRP ledger. These are not speculative signals. These are documented institutional commitments. The $20 world is not the world being built right now. Voice. Signs we're entering the $250 world. So if the $20 world is behind us, the natural next question is, where are we now and what does the path forward actually look like? Based on the current evidence, we're in the transition zone between the $20 world and the $250 world. And the signals that define the $250 environment are starting to appear with increasing frequency. Exchange reserves of XRP are sitting at multi-year lows. That's not a coincidence. That means XRP is leaving exchanges and moving into custody arrangements and cold storage, which is the signature behavior of institutional accumulation, not retail speculation. CryptoQuant's on-chain data has documented this institutional cold storage accumulation pattern clearly and consistently over recent months. The Clarity Act, the legislation that would provide the comprehensive regulatory framework for digital assets in the United States, is reportedly just weeks away from markup in committee. That's the legislative gate that unlocks a massive wave of institutional product development. The SEC sandbox framework is already enabling regulated entities to begin building institutional-grade XRP products in a compliant environment. All of these signals point to the same thing: the supply contraction, the regulatory clarity, and the institutional infrastructure are converging simultaneously. That convergence is what drives the repricing from the $20 world into the $250 world. And based on the timeline of the documented evidence, that transition is not a 2028 or 2030 story. The groundwork is being laid right now, in real time. Voice. The architecture of the $1,000 world is being assembled. But here's what makes this moment truly extraordinary, and what separates Today Assets Report's analysis from almost everything else you'll see in this space. It's not just that we're moving toward the $250 world. The evidence suggests that the architecture for the $1,000 world, the world where XRP is actually routing billion-dollar institutional settlement volume, is being assembled simultaneously. And the specific institutional moves that define that architecture are already documented. Ripple's current valuation sits at approximately $50 billion. That's not a retail-driven speculative number. That's the market's assessment of an enterprise payments infrastructure company with real institutional contracts and real transaction infrastructure. Hidden Road, a prime brokerage and clearing firm that Ripple recently acquired, brings $3 trillion in annual clearing capacity into the Ripple ecosystem. $3 trillion in clearing, that's not a payment startup. That's institutional financial market infrastructure. Banking Circle, which processes over $1 trillion annually in B2B payment flows, has been brought into the XRPL ecosystem. Grayscale has positioned XRP within a dedicated currency sector product, signaling that major asset managers are beginning to categorize XRP not as a speculative tech token, but as a currency-class settlement asset. Each of these moves is a brick in the architecture of the $1,000 constraint world. None of them individually pushes the price to $1,000. But together, they represent the systematic assembly of the infrastructure that makes the engineering constraint binding rather than theoretical. Voice. The gate between the two worlds. Here is perhaps the most important practical insight from everything we've laid out today, and it's something that every serious XRP holder and investor needs to understand clearly. The Clarity Act is not just another piece of legislation. In the context of this specific analytical framework, the Clarity Act is the gate between the $250 world and the beginning of the journey toward the $1,000 constraint world. Here's why. Right now, every major financial institution in the United States that wants to build products and infrastructure around XRP faces a fundamental legal uncertainty. They can't move forward at full institutional scale because the regulatory framework hasn't been codified into law. They're operating in a gray zone where every major deployment decision carries legal risk. The Clarity Act eliminates that gray zone. Once passed, it creates a clear legal pathway for banks, broker-dealers, asset managers, and payment processors to build on XRP infrastructure without regulatory ambiguity. And when that gate opens, the institutional deployment announcements that are currently being held back will begin to flow into the public record in rapid succession. That's when the supply dynamics that Grok correctly modeled, the effective liquid supply contraction, collide with the institutional settlement demand that Gemini's engineering constraint framework describes. That collision is what produces the price dynamics that none of the three AI models fully captured. And the timeline on that gate opening is not years away. It is, based on current congressional reporting, potentially weeks away from its first major markup milestone. Voice. What the math actually says when you follow it all the way. Let's follow the math all the way through, because this is where everything comes together into one coherent picture. Start with a real transaction size, $1 billion, which is not unusual for institutional cross-border settlement in corridors like the US to Europe or US to Southeast Asia. At $20, that transaction requires 50 million XRP. Given effective liquid supply constraints, that order moves the market against you so hard the economics don't work. You're better off using the old system. At $250, that transaction requires 4 million XRP. Better, but still a significant portion of effective liquid supply and active trading, creating meaningful slippage in high-volume settlement windows. At $1,000, that transaction requires 1 million XRP. That's manageable. The market impact is minimal. The economics are favorable compared to correspondent banking. The system works. Now scale that to the daily transaction volumes of the corridors that institutions actually operate in. Not $1 billion transaction per day, hundreds of them across dozens of corridors simultaneously. At $1,000, the system can handle that volume without the settlement economics breaking down. Below $1,000, as transaction sizes and volumes scale toward swift comparable levels, the slippage mathematics increasingly favor the old system over the new one. This is what the engineering constraint means in practice. It's not a price target driven by optimism or hype. It's the minimum price at which the architecture that has been built and is being built can actually deliver on its promise at institutional scale. The math doesn't lie, and the math says the constraint is real. Voice. Why this analysis changes how you should think about XRP. Understanding the engineering constraint framework doesn't just give you a better price target. It fundamentally changes how you should think about XRP as an asset and what signals actually matter for its long-term trajectory. If XRP is primarily a retail speculation asset, the $20 world, then the signals that matter are sentiment indicators. Social media volume, retail inflows, market cycle comparisons, technical chart patterns. If XRP is primarily a sentiment-driven institutional ETF asset, the $250 world, then the signals that matter are ETF inflows, supply contraction data, and regulatory milestones. But if XRP is a bridge asset moving toward engineering constraint activation, the $1,000 world, then the signals that matter are completely different. What matters is XRPL transaction volume growth. What matters is the size and frequency of ODL transactions. What matters is whether the institutions that have signed up for the infrastructure are actually routing real settlement volume through it, and at what transaction sizes. What matters is whether the Clarity Act actually passes and triggers the wave of institutional deployment announcements that are currently being held back. These are not the signals that most XRP analysts track. They're not the signals that ChatGPT or Grok modeled. But they are the signals that will tell you whether the $1,000 constraint is becoming binding or remaining theoretical. And right now, those signals are moving in one direction. Voice. The evidence summary. Where all three worlds stand today. Let's do a clean summary of where the evidence stands across all three price worlds, because clarity matters here more than excitement. In the $20 world, XRP is a retail speculation asset. The evidence that we've moved past that world includes Goldman Sachs's documented ETF position, the DTCC's XRPL settlement patent, Brazil's sovereign bond tokenization on the XRP ledger, the SEC and CFTC's joint commodity classification, and MasterCard's $1.8 billion infrastructure acquisition tied to RLUSD on XRPL. That world's evidence is closing behind us. In the $250 world, XRP is an institutional ETF and supply dynamics asset. The evidence that we're entering this world includes exchange reserves at multi-year lows, documented institutional cold storage accumulation, the Clarity Act approaching markup, and the SEC sandbox enabling institutional product development. That world's entry signals are flashing. In the $1,000 world, XRP is routing actual institutional settlement volume at billion-dollar transaction sizes. The evidence that the architecture for this world is being assembled includes Ripple's $50 billion valuation, Hidden Road's $3 trillion clearing acquisition, Banking Circle's $1 trillion processing integration, and Grayscale's currency sector positioning of XRP. We are not in the $1,000 world yet. But the structural evidence makes it increasingly clear that we are not building toward it gradually. We are building toward it rapidly, and the gate between here and there has a specific name and a specific timeline. Voice. Final takeaway. The right question has a mathematical answer. Here is the bottom line, and I want you to carry this with you beyond today's video because it's the most important analytical insight in everything we've covered. ChatGPT asked how high XRP's price could go, driven by retail sentiment and market cycles. Grok asked what XRP's price would be if supply dynamics and institutional adoption both fired simultaneously. Gemini asked what price XRP must be for its settlement architecture to function at institutional scale. Only one of those questions is the right one. And only one of those questions produces an answer that is grounded in the engineering reality of what XRP was actually built to do. The answer to that question is not $20. The answer might not even stop at $1,000 if global settlement volumes continue to scale and institutional adoption accelerates beyond current projections. What the current week's evidence? Brazil Treasury bonds deploying on XRPL, NASDAQ tokenization infrastructure advancing, the Clarity Act moving toward markup, tells us is that the constraint is becoming binding, not theoretical. The infrastructure is being assembled in documented, verifiable steps. The institutions are making real financial commitments, not just exploratory statements. And the math, when you follow it from $1 billion settlement transaction to 1 million XRP at $1,000, doesn't require you to believe in hype. It just requires you to follow the engineering. I'm your host at Today Assets Report. The right question is the constraint. The constraint is being activated. And the math, when you follow it all the way, does not lie. We'll see you in the next one.